Work all year, save your money, and with one bad investment decision, you're back to square one. That's exactly what happens to a lot of people.
Most people invest like this. They hear a story, they fall in love with the story, and then they ignore the environment. Crypto gets sold as freedom, speed, rebellion, and upside. Gold gets mocked as boring, old, and for doomsday people. But markets do not care about your favorite story. Markets care about liquidity, fear, interest rates, inflation, and trust. And in America right now, those forces are not theoretical. Inflation in the latest CPI release was running at 3.3% year over year. The Federal Reserve held rates in a 3.5 to 3.75% target range in March 2026. Meanwhile, the Congressional Budget Office projected a $1.9 trillion federal deficit for fiscal 2026, with debt held by the public at 101% of GDP. That is the backdrop investors are navigating. So the pain isn't just, I picked the wrong trade. The pain is deeper. It's working 40, 50, 60 hours a week, saving aggressively, trying to build financial freedom, and then discovering that one bad allocation decision can set you back an entire year. That's how wealth gets delayed in America. Not always by laziness, not always by low income, sometimes by misunderstanding the cycle. So, let's run the experiment. Imagine two investors on the same day. Investor 1 takes $1,000 and buys Bitcoin at around $81,078 per coin on April 10, 2025. Investor 2 takes $1,000 and buys gold. 1 year later, gold is about 46.8% higher than it was a year earlier. Now, before the comment section explodes, let me say this clearly. This is not proof that gold is always better than crypto, and it's not proof that Bitcoin is dead. This is something more useful. It's proof that the asset you want emotionally is not always the asset the macro environment rewards financially. And by the end of this video, I'm going to show you the one insight that matters far more than whether you're Team Crypto or Team Gold. Because the biggest winners don't just ask, what's the best asset? They ask, what environment are we in, and which asset is built for that environment? Let's make this real. John is 31. He works a decent job. He's tired of the 9-to-5 treadmill. He looks at home prices, student debt, healthcare costs, insurance, groceries, and he feels like traditional finance has failed him. So when he hears the Bitcoin story, it hits him emotionally. A fixed supply, a system outside government, a shot at escaping the slow grind. John puts in $1,000 because he doesn't just want a return, he wants hope. Sarah is 42. She's not trying to get rich in one cycle. She's trying to protect what she has. She sees the same headlines John sees, but she interprets them differently. Geopolitical tension, sticky inflation, giant deficits, policy uncertainty. She doesn't want excitement. She wants resilience. So Sarah buys gold. 1 year later, John opens his app and sees around $810. Sarah looks at her allocation and sees roughly $1,468. But here's the part nobody talks about. After inflation, John's real purchasing power is even worse. And Sarah's gain, while less glamorous than a crypto moonshot, becomes far more meaningful because it preserved and expanded wealth in an uncertain year. Using the latest 3.3% CPI as a rough inflation yardstick, Bitcoin's $810 falls to roughly $784 in real terms, while gold's $1,468 becomes about $1,421 in real terms. That's the psychology of investing in one scene. One investor bought a dream, the other bought insurance. And in this 12-month window, insurance beat the dream. Gold didn't win because it suddenly became innovative. Gold won because the environment favored what gold does best. The World Gold Council described 2025 as a remarkable year for gold, saying it achieved more than 50 all-time highs and returned over 60% by late November. They pointed to a mix of geopolitical and economic uncertainty, a weaker US dollar, and strong buying from both investors and central banks. That matters because gold is not really a growth asset. Gold is a trust asset. When investors trust growth, they chase earnings. When they trust innovation, they chase tech. When they trust liquidity, they chase risk. But when they start questioning policy, currency strength, deficit discipline, geopolitical stability, or the durability of paper wealth, gold suddenly stops looking old. It starts looking useful. And look at the US backdrop. Inflation re-accelerated to 3.3% in the latest CPI report, with the energy index up 10.9% in March and gasoline up 21.2%, accounting for nearly 3/4 of that monthly all-items increase. The Fed said inflation remained somewhat elevated, while uncertainty around the outlook was also elevated. That is a near-perfect emotional recipe for gold. Not total panic, not total calm, just enough uncertainty to make people ask one dangerous question. What if the system is less stable than it looks? And once that question enters the room, gold starts getting invited back into the portfolio. Now let's talk about Bitcoin. Bitcoin's problem over this one-year period wasn't that its long-term thesis disappeared. Its problem was that the market stopped rewarding that thesis in the short term. According to the Case Bitcoin data, Bitcoin was around $81,078 on April 10, 2025, and the one-year return by April 10, 2026 was roughly negative 19%. That tells you something critical. Bitcoin may talk like an inflation hedge, but in many real-world periods, it still trades like a high-beta liquidity asset. In plain English, when optimism is rising, liquidity is easy, and investors are willing to dream big, Bitcoin can behave like a rocket. But when markets become more defensive, when expectations were already too high, and when macro uncertainty starts dominating the mood, Bitcoin often stops behaving like digital gold and starts behaving like volatile risk. That distinction destroys people because they buy Bitcoin expecting stability against the system, then get hit with the emotional reality of drawdowns, volatility, and timing risk. And that's why so many Americans mishandle crypto. They size it like a savings account dream, when they should size it like a venture-style bet on a different monetary future. Bitcoin is not just an asset, it is an emotional amplifier. If you buy it in the wrong environment, it can test your conviction fast. Now, here's where most people make the next mistake. They look at this one-year result and say, see, gold is smart money, crypto is gambling. That conclusion is just as shallow as saying the opposite, because zoom out and the picture changes dramatically. On Case Bitcoin's long-term comparison table, Bitcoin's 10-year ROI is shown around 15,391%, while gold's is around 273% over the same horizon. So over this year, gold beat Bitcoin badly. Over the decade, Bitcoin crushed gold. Do you see the real lesson now? The question is not which asset wins. The real question is, over what time frame, under what macro conditions, and for what kind of investor? That is how professionals think. Not in memes, not in identities, not in tribes, in regimes. If you want to think like an economist instead of a cheerleader, break the market into 3 regimes. Regime 1. High uncertainty, shaky confidence, sticky inflation, big deficits, and demand for safety. That's where gold shines. Regime 2. Falling rates, easy liquidity, rising risk appetite, and belief in upside. That's where crypto can absolutely explode. Regime 3, a messy middle where inflation is above target, rates are still restrictive enough to matter, growth is uneven, and policy credibility gets questioned. That's where investors become selective, emotional, and confused. And honestly, that third regime looks a lot like the US environment we've been dealing with. The Fed is still operating with rates at 3.5 to 3.75%. Inflation is still above target at 3.3%, and the federal budget deficit for 2026 is projected at $1.9 trillion, with debt held by the public at 101% of GDP. That does not scream clean, low-risk, growth-only environment. And in a messy middle, boring assets can outperform exciting ones. That's one of the hardest truths in finance. Here's the biggest insight in this entire video. Gold and Bitcoin are not solving the same problem. Gold is trying to protect your balance sheet when trust gets shaky. Bitcoin is trying to radically outperform if a different monetary future arrives faster than the market expects. Gold says survive. Bitcoin says escape. Gold is about durability. Bitcoin is about asymmetry. Gold is what you buy when you want your wealth to feel harder to break. Bitcoin is what you buy when you want your wealth to have a chance of being reborn at a higher level. And if you confuse those two jobs, you will constantly be disappointed because you'll expect gold to make you rich fast, or you'll expect Bitcoin to make you feel safe, and neither asset was designed to do both at the same time.
So, if we're being brutally honest, if your time horizon on April 10th, 2025 was only 1 year, gold was the better bet. A $1,000 gold position becoming roughly $1,468 is not just a better return than Bitcoin's $810, it's a completely different emotional experience. One feels like preservation with progress. The other feels like conviction under pressure. But if your time horizon is 10 years, your risk tolerance is high and you can emotionally survive brutal volatility, Bitcoin's historical upside remains in a different universe. That's why wealthy investors don't always ask, what's the highest return? They ask, how much safety do I need? How much upside can I tolerate? How much volatility can I survive without making a stupid decision? Because in real life, the best asset is not the one with the most upside on paper. It's the one you can actually hold through reality. So the next time someone says gold is dead or crypto is the future, understand that both statements are emotionally satisfying and financially incomplete. In the US economy, assets respond to different mixtures of inflation, deficits, rates, growth, and fear. This past year, the ancient metal beat the digital rebel, not because history moved backward, but because the macro environment reminded investors that before you chase freedom, you usually pay for security. And that's the truth most people learn too late. You do not build wealth by worshiping one asset. You build wealth by matching the right asset to the right regime. If you understand this, you're already ahead of most people shouting online about markets, because serious investors don't just ask what went up, they ask why it went up, when it tends to win, and what role it should play in a portfolio. And once you start thinking that way, you stop investing like a fan and you start investing like an owner. A year is long enough to humble conviction, but short enough to mislead conclusions. Gold won this round. Bitcoin still owns one of the strongest long-term return profiles in modern finance. The real edge is knowing which job you need your money to do. Thanks for watching. If this helped you clear through the noise, hit subscribe. I'll see you in the next one.